Thank you, Mina, Sean, and Harding, NorCal Real Estate Mastermind. I think this is my fourth time being able to speak. I did creative financing, I did deal market analysis, I did syndications before. I have all of those workshops as well. Today, they asked me to talk about development and new construction. So I'm gonna be talking about that very high level. Also gonna be talking about how we look at new construction ROI analysis, just very typical, but without going into any specific deals per se, and then some best practices. And this is one of the deals that we did here in downtown Sacramento on 12th and E. It's a 132 unit called the Esperanza. Before jumping into the presentation, want to let you know that everything I cover is informational purposes only. I'm not an attorney, not a financial advisor or accountant. Educational purposes only. The financial ideas that I cover are not guaranteed. Any of the ideas I cover, I assume you'll do your own independent verification, and there are risks associated with real estate investing, and there's a chance you could lose it. So with that, a little bit about myself. I have been here in Sacramento for 20 years. I started off in government in 2006, worked for Senator Don Prada, then the lieutenant governor, then I worked for a congressman, then I was working in Congress until 2015. My mom got cancer, and as the eldest son of immigrant family, I realized I needed to make more money. I left to go into real estate, and actually the very first real estate deal I did was development, was new construction. And I'm gonna talk about why that was probably the best decision I made, was not going into like a rental property one at a time, but going into new construction development, which changed my life. And then from there, in the last 10 years, now I own 15 properties, all here in Sacramento. That's now over 100 units. And I've now been a part of 11 new construction development deals. And again, the 15 properties, what's interesting is that they're all in Sacramento and Davis. Actually, a majority of my properties are in the city of Davis, and I've driven to all of my properties within 3 hours. I would say that's one of my superpowers as a real estate investor operator, is to be able to just go check on all of my properties and team members. So the punchline of today's workshop is, I don't care if you're new or you're experienced or advanced, everyone should have the developer mindset. And what is a developer mindset? It means fundamentally you're thinking like an engineer, right? So you're thinking first principles. You're thinking like, okay, what is the exact problem I'm trying to solve? Do I understand those realities? Like, what of those realities are actually true? And then how am I going to reverse engineer a solution and an objective? And how am I going to iterate all of the different approaches to get to that objective? And so I don't care if you are going to develop any kind of product, you should have this mindset when you're developing your portfolio. Because for many of you who have heard me talk before, my whole punchline is, it's not about investing in one property, it's investing into your next 4 properties. Because one property is not going to give you cash flow, it's negative cash flow. 2 properties maybe break even. Third property, you get some cash flow. It's really the 4th property where you're like, oh, I have dividend income now. And so that means you're thinking portfolio mindset, right? Of like, which of my properties are gonna be equity multiple? Which of my properties are cash flow? Which of my properties are tax strategies or tax harvesting? Which of my properties are, can I do something creative, right? And in your portfolio, like I've said this before, it takes 10 years, right? Anyone who's like, oh, real estate is a get rich fast, like it's not fast. Like there's so many more ways to make money faster. Like it actually takes 10 years, but surprisingly, 10 years goes by quick. Like I think about this last 10 years, how I got 15 properties, I'm like, holy cow, that went by really quick. So if you focus from now and you think a 10-year horizon, that is the right mindset. And again, you're thinking about 10-year portfolio architecture. But the purpose of today's talk is, what does it mean to develop a new product, a real estate product? And there's 14 different asset classes, right? From self-storage, warehouse, flex, single family, multifamily, like it goes on and on. And the idea is, why would anyone do that, right? And the idea is to be able to achieve outsized returns that you're not going to get from a light value add or a heavy value add play. But the main thing is that you have the confidence to mitigate the risk, because real estate development is like, if we're thinking about the stock market, it would be like the tech stocks, right? It has the highest chance of like outsized returns, but it's the highest risk where you could just lose your shirt. And if you aren't coming in with the mindset of, I am learning how to mitigate all the technical risk, then you could be in trouble. And again, I'm gonna start off with the why. Why are we talking about new construction and development? Again, outsized returns, you're not gonna find this in light value add. You're not gonna even get it in Airbnb or anything else. Like, it's really about being able to develop what I call or position yourself at the highest, best use of land. And when you go to any city or any community, you see that, the coffee shop in the wrong location, or you see a certain building in the wrong location. The idea of new construction is you get to choose best product type, best location, right? You're not constrained by any of the existing infrastructure or the structures. Second, the idea is you are maximizing the delta from vacant land, right? So if you go from an already nice building and you make it a better building, that delta is something. But if it's like from vacant land to a nice building, that's a much larger delta that you're going to be in, value creation that you'll be able to capture. And when you sell it, that exit cap, you're going to be able to experience that profit. And the reality is this, like, rents right now, I would say Sacramento market and including the Davis market, like, we are in market correction, right? So we're not seeing aggressive rent growth. We're seeing negative rent growth, right? But the products that are doing well are the newer products. If they've been around, they've built the last 5-10 years, so Class A products, they're still achieving really high rents, really good rents. And so there is value because it's modern layout, design, features, all of the above. And of course, if you build something new, you're not worried about all of the long-term maintenance issues, because everything is new. So like the plumbing issues, electrical issues, foundation issues, you won't have to worry about that for 20 years. And also, a lot of the new builds are just much more energy efficient. They're operationally more efficient. So another way to increase your NOI. And with new development, new construction, and especially this year, there's going to be a lot of opportunities, tax benefits, right? With new construction, there's larger depreciation you can capture, and with the big, beautiful build, there's the opportunity zones, especially for the rural opportunity zones that are going to be decided this summer, right? And so any of these communities considered rural, that step-up basis is going to be very powerful. 30% step-up basis, you can virtually wipe away your capital gains. So you sell your tech stocks and invest into a new construction deal in a rural community. That can be a very powerful tax harvesting strategy. So in Greater Sacramento, and this again is not any specific deal, this is my experience. I have now done 11 new construction deals that I've been a part of, and I have seen anywhere from 75% return on investment to 300% return on investment. If it's anything lower than 75, I'm like, I'm not interested. Anything higher than 300%, I'm like, that's fishy, right? So like, I have seen deals usually 75 to 300%, and around 3 to 5 year like deal life cycle. Oftentimes it could be longer than 5-year life cycle. And really there's 3 business models. And so the business model that I have the most experience is called entitlement and disposition, called entitle and flip, which is really fix and flip, right? So if you're a fix and flipper, that's how you get started, where you buy the land, ideally off market, and then you handle all of the soft costs, right? So you hire the architecture, the civil engineer, the mechanical engineer, and you negotiate a development agreement or whatever the city needs for you to get approval of that. Then you sell the land to an actual builder, right? So I developed nothing. All I was a glorified wholesaler. But to the city of Sacramento, my development application says Andrew, the developer, right? So you are a developer, but you didn't develop anything. All you developed was on paper. So you're considered a paper developer. However, you can actually make more money if you do the entitlements and then you get the site permit ready to build whatever you got entitled. And if you want to increase it a little bit more, you do the entitlement, get the building permits approved, and get the rough infrastructure, grade it, get the plumbing, get the conduits, electrical. Then you can get a little bit higher returns when you sell it or joint venture with a construction company or a GP that is going to handle the construction. Business model 2 is you are entitling and you're doing the construction, and your goal is to sell once the rents are stabilized. And the third is you entitle, construct, and then you hold long range because you realize this is a great location, great rental market. So in all three of these scenarios, you can see returns changing a little bit. And again, this is from my experience in Sacramento and in Davis. But here's why this is so interesting. So I would say typically right now, if I'm gonna do a new construction deal, like as a limited partner, as a general partner, as a joint venture, I need to see triple digit returns. If I'm not seeing triple digit returns, I'm like, I'd rather do a fix and flip. I'd rather, do anything else. Airbnb, co-living, all the other models. So there are deals I'm working on right now that again are achieving triple digits, so 100% return on investment. So if we were to look at 3 different models, right? If you were to invest $100,000, and this is just generally in Greater Sacramento, development versus dividend returns. If you were to do $100,000 and put it in the stock market, and you get an 8% annual return. So 8% annual return after year 1, 2, 3, 4, 5, essentially you've made $47,000. So that's essentially a 47% compounded return. Rental property actually is lower than the stock market if you are talking pure cash on cash dividend return, right? It's actually 4 to 7%, and from my experience right now, it's 5%. If you can achieve 5%, it means you're crushing it right now in Sacramento. Actually, 5% is hard. Like you have to have like a really strong property management team, really know to have all your costs dialed in, and maybe you achieve a 5% cash on cash return. And so I modeled it for 5.5%. Right? And then so you're essentially making $30,000, so 30% return. However, again, this is untrended, meaning it doesn't account for appreciation. It doesn't account for depreciation. It doesn't account for amortization. This is just pure dividend return. You get 30% on rental property, 47% stock market. Again, real estate development, we're talking about 100% return. Year 1, construction. Year 2, finish the construction, refinance. Year 3, we begin returning capital to investors. Year 4, we stabilize the rents, we prepare for exit, and you get your $100,000 back and an additional $100,000 for that 100% return on investment. And so when I see this math, I'm like, oh, should I start off, if I have $100,000, try to make $30,000 in the next 5 years? Or if I have $100,000, can I try to make $100,000 in the next 5 years? But here are the preconditions for when you do development. And from my experience, all of these conditions must be true. Like if one of these conditions are off, then I would not do it. So like all of these conditions, number 1, replacement cost basis, meaning that if assets right now are trading, like any kind of assets, like apartment buildings, commercial buildings are trading 30% or 40% higher. Let's just say even 30% as a basis. 30% higher than replacement costs, then it means maybe it makes more sense to build it, right? Because like it means that there's high inflation on that product type, and now you're buying a Class B or Class C building, 30% more expensive than just building a brand new one, right? So especially if it's 40% more than replacement cost, then there's actually a really strong case to just build the product, because again, you have a new product, less deferred maintenance, more energy efficient, you can achieve higher rents with a new product and more tax benefits. Number 2, land cost basis. If you buy the land at an incorrect price, then the new construction deal, doesn't matter if you have the best construction team or what have you, you're gonna lose money. And so it is so important that you are able to buy the land off market, or you can buy it as low as possible. So the most accidental way to become a developer is an ADU, where you own the land outright. You already own the land, so now the development land cost basis is 0. because you already own the land. And so that is actually how people start off as being a developer. So it's very important that you are very mindful of the land cost basis. Then ultimately what's different about new construction is macro market forces. In light value add or all of these different strategies, micro forces are important, but in development, we're talking about the major macro forces. If the macro forces are not with you, then you're in trouble. So I'm talking about significant private investment coming into that location, business growth, job growth, population growth, public investment. If that's not happening, then it is very speculative, very concerning to like invest a lot of money on new construction. And then very important is wherever you are developing, there are existential supply constraints. And what we've saw in the Sunbelt city states where there weren't supply constraints, like the city of Austin, where they built 50,000 new units in 2025. I mean, they dropped like 20% in value, negative rent growth, all of that because they could build an unlimited amount of supply. So now you're competing against BlackRock, every single potential development company that could build. However, if you're building in Monterey or Newport Beach, I mean, obviously that's SoCal, but like in areas where there's topographic, environmental constraints or government land use constraints, like the city of Davis, where they literally do not allow you to build unless you get a vote of the people. That gives you really strong market forces in your favor. And next is product market fit. And not just product market fit, but product model fit, right? So it's not just developing whatever you want to develop. You have to develop the product type that has the highest demand, right? So what happened during the pandemic is all of the real estate developers in downtown Sacramento saw all these Bay Area tech people come in, like, oh, we're gonna build high-end apartments. And so Sacramento went gangbusters on building all these super high-end apartments where it costs $3,000 a month, right, for an apartment, but you have like these gyms and pools, and the reality is $3,000 a month, you could like have a nice house that you could rent, or that's like a mortgage. But the reality was that absorption rate, it was not absorbed. And they were continually building it. They're still building it, right? And so now what the product market fit is affordable housing or the missing middle product type, but that may change too. So the idea is you have to be in tune with the market. What does the market want? And you have to be actually ahead of the curve because you need a working hypothesis where you're like actually seeing a little bit farther than other folks. And same with the model. Are you building something to rent or are you building something to sell, where you're building condos or townhomes that you could eventually sell? And then ultimately, you need access to the right people, right? Because you already know real estate is a team sport. Like, real estate development is like of the most complicated team sports, right? It is like the NFL of team sports where you need all these technical people in every step, and you need the right people with experience, people who are proven, and people you can trust. And if you don't have that, then you can have all of these other preconditions and you can still lose money. And so from my experience, you need all six. If any one of these are missing, the risk is high, and I would probably say no to the deal. And so all six are important. And so what is the team? And you know, it's so interesting when there's all these different business models in real estate, and it's like the how is all these technical things. In real estate development, the how is just people, right? In real estate development, you don't need to know anything about real estate development. You just need to know people, right? So it's definitely not a what problem, it's a who problem, right? So here are the principles that you need in your deal. From whoever the GP or the general partner, manager, sponsor, they're the ones looking for the deal, looking for the property, structuring the deals. The lead investors, equity partners, raising the capital, the lenders, and there's multiple types of lenders, right? There's gonna be lenders who are gonna do the construction financing, lenders who are gonna do the permanent financing, lenders who may come in with mezzanine debt. There's gonna be, who's gonna be the loan guarantor, right? And then the soft costs. Soft costs, this is where, like, if you're an entitlement specialist like me, we're really good at this part because this is what we have to cover out of our pocket, right? And to get the government to approve us. And that starts with attorneys who are going to be negotiating on our behalf with the city, understanding all of the technical elements of the general plan and the city code, the architects who are gonna come up with the vision of like whatever you want in like create a plan that you can submit to the city. Civil engineers who are going to work with the city to make sure like all of the infrastructure is done. The structural MEP, which is mechanical engineering and plumbing engineers, and the consultants if there's any environmental issues. And then there's hard costs, which is really the general contractors who hired the subcontractors. And then there's post costs, like once the development is complete, brokers and property managers. And the idea is you need to know someone in every one of these categories, right? And if you don't, then you're not ready yet for development. However, there are ways to be involved without you having to know all of these people, which I will cover in right now. So here are 3 different scenarios of development that I have done, and I'm going to share 3 different stories. So scenario 1 is you're going to be a solo GP. Like, I'm going to be the main developer. I'm going to do it myself. I don't need any partners. I don't want any of that. So essentially, heavy value add, if you're doing renovation and you're literally gutting the house and you're going back to the studs, essentially you're a developer. Because at that point, that is like new construction. You're taking the same amount of risks. So back to the studs.
5 minutes.
What was that?
5 minutes to 7.
Minutes. Okay. Then second is ADUs. Again, we mentioned that. Custom home build, and then entitled project and flip. That's how I got started in new construction. Second is joint venture, where you do any one of these things, and then you partner with other GPs, so co-GP, where you're contributing the land, you're doing the entitlement, or you're raising the capital, or you're taking the lead on the construction, right? And what we're seeing in Sacramento right now is most of the developers don't take on all of this by themselves. They spread the risk out, because then you can stratify the cost and the expertise, because a lot of developers have unique expertise on these. And then LP with GP, and this is really about that you really don't need to know any of this. You just need to have capital to invest with the general partner, where you can invest in common equity, where there is no upside cap, but there's a lot more risk. There's preferred equity, where there's downside protection because they're gonna guarantee a certain amount you're gonna get paid out before common equity. There's mezzanine debt and senior debt. And I'll share my case studies another time. Okay, and then here's the risk level in real estate development. So first is land cost basis. If you buy the land wrong right from the get-go, like, you're gonna be in trouble. If you can't get the entitlement, and here, like, if you find out that you're too close to a gas station and there's an oil spill, or too close to a laundromat, or if the property is historical designation, or there's too many properties that are like designated as a historical neighborhood, or the neighbors are NIMBYs, they only want 3 floors, but you're not gonna pencil unless it's 5 floors, right? And you need government political support, or you don't have it. Or you don't have enough capital to take down the land, or the equity to do the construction loan. Or when you're actually operating, you're not able to achieve the rents, or you're not able to sell at the back end with achieving the cap rate because interest rates went crazy. This is assuming that you have a stellar team. You have the general partner, asset manager, general contractor, you have amazing people. Still, you have risks on all 5 of these elements. So that's really the job of the developer, is to mitigate those risks. Okay, and so here's the reality. Most new construction deals right now we're looking at do not pencil because of interest rates, market forces, and there is lack of product market fit opportunities for retail investors. So funding has been a lot more challenging for real estate developers, and what we realize in order to make these deals pencil is you have to stack a bunch of strategies. And if you are not stacking all of these strategies, then for a real estate developer, I don't know how they're making money. So we're stacking all of the ministerial, like SB 1123, where you could build 10 ADUs by right per acre. Stacking it with the various other ADU laws. The city of Sacramento has their own infill ministerial by right. Being able to apply with SB 330 to lock in your design standards and building fees, being able to unlock the density bonus, developing close to public transit so you don't have any parking exemptions, additional parking exemptions, being able to leverage the welfare tax exemption so you can get property tax abatement and other legal strategies. So the idea is to stack all of these strategies to make your deal pencil. But what's great about real estate development is if you work with the right developers, there are different ways that you can make money as a general partner, limited partner, and joint venture partner. And if you want more information, you can download my book. So please feel free to download my book. Oh yeah, thank you. Thank you. And I will take one personal point of privilege. So I do have 2 different deals that I won't be able to go into in detail, but if you are interested in learning about, I'm doing 2 development deals. One, I'm involved in a multifamily development deal in the city of Davis right now. Very strong upside potential, again, triple-digit returns, strong downside protection, excellent location, fantastic general partner team. Text me the detail. Text me your name and email, and I will send you more details. And then the second one is a new deal. It's an ADU development play where there's a 4-plex that is off market. We're about to buy it for $800,000. It's on about half an acre, and we can build 4 ADUs, and that is another play. If you want more details, text me your name and email. And with that, thank you very much for joining us tonight.